The hidden force behind wealth, why compound interest changes everything. What if the most powerful force in finance is something you can't see, can't touch, and barely notice working in real time? Albert Einstein once called compound interest the eighth wonder of the world. Benjamin Franklin used it to build a fortune he never lived to spend. Warren Buffett credits nearly all of his wealth to its unstoppable momentum. But what exactly makes compounding so extraordinary? Why do so many investors underestimate it? And how can patience turn the smallest seed of money into a massive tree of wealth over time? To understand compounding, we must first accept an uncomfortable truth: humans are terrible at understanding exponential growth. Our brains evolved to navigate a world where progress was linear and predictable. If you walked 10 meters each day, you ended up exactly 100 meters after 10 days. But imagine doubling a single penny every day for 30 days. The number looks tiny at first: 2 cents, 4 cents, 8 cents. After 2 weeks, you don't even have $100. Most people would assume the outcome is unimpressive. Yet by day 30, you have over $5 million. That is the quiet, invisible magic of exponential growth. It looks like nothing is happening, until suddenly everything is happening. Now consider investing. If you invest $10,000 at a 10% annual return, that's only $1,000 growth in year one. Boring, right? Many investors quit when excitement fades. But what if you stay patient for 40 years? Your $10,000 becomes over $450,000 without adding a single extra dollar. Did the 10% change? No. What changed was time. Compounding turns time into a financial multiplier, rewarding those who wait and punishing those who rush. And yet, the majority of investors behave as if compounding doesn't exist. Why? Because sometimes patience feels like doing nothing. And doing nothing feels wrong, especially when others are rushing into hot stocks, chasing quick wins, or panicking at every market dip. The market goes up, and greed whispers, "You're missing out." The market drops, and fear screams, "Get out now." The emotional brain hates patience. It wants action. It wants control. It wants results now. But the market rewards discipline, not excitement. So let's ask a tough question. Are you investing to feel smart today, or to be wealthy tomorrow? Investors who understand compounding think differently. Every dollar is a tiny employee they send into the world. Each year, those dollars work to earn more dollars. And soon, the new dollars start working too. Over decades, your money becomes a self-growing organism. Warren Buffett didn't become one of the richest men on earth just because he is brilliant. He did something even more powerful: he started early and refused to stop. At age 30, Buffett had just over $1 million. By 60, he reached $3.8 billion. By 90? Over $100 billion. Same person. Same strategy. The only difference was time and the snowball of compounding rolling downhill, bigger, faster, unstoppable. So why do many fail to capture its benefits? Because compounding challenges our patience in 3 painful ways. First, the early years feel like stagnation. All the real growth happens later, much later. Second, progress is invisible. Your wealth doesn't dramatically change overnight. You need faith that the numbers will eventually explode upward. Third, you must stay invested through chaos, recessions, crashes, terrifying headlines, and moments when everyone else is giving up. Compounding doesn't require genius. It requires endurance. Imagine planting a tree. For years, you water the soil, see nothing dramatic, and sometimes wonder whether you wasted your time. But deep underground, the roots strengthen. Then one day, growth erupts, and the results become impossible to ignore. The greatest investors on earth don't win by predicting the future. They win by outlasting those who quit too early. So ask yourself, do you want fast excitement or lasting freedom? The investor who checks their portfolio every hour suffers emotional damage with no financial benefit. But the investor who checks once a year may enjoy both peace and prosperity. Compounding is the quiet partner in your financial journey. It's the force that never sleeps, never gets tired, and always shows up tomorrow stronger than today. But only if you let it. This brings us to a critical mindset shift. In investing, time is more important than timing. Buying and selling at the perfect moment is a fantasy sold by traders and media hype. Long-term investors don't try to catch waves, they let the tide lift them. The market, over time, rises. Compounding ensures you rise with it. So as you continue this journey into the power of compound returns, keep one powerful idea at the front of your mind: getting rich slowly is the fastest way to financial independence. Why patience is the most undervalued skill in investing. If compounding is the engine of wealth, then patience is the fuel that keeps that engine running. Yet patience is often treated as a passive trait, something simple, effortless, an act of merely waiting. But in the world of investing, patience is one of the hardest skills to master. It requires emotional resilience, confidence in uncertain outcomes, and the courage to ignore what everyone else is obsessing over. So why is patience so rare? Because the modern world conditions us to crave immediacy. We check our phones every few minutes for notifications. We stream movies instantly. We expect fast shipping, fast service, fast success. But wealth is not built on a fast timeline. In fact, everything about long-term investing feels like it goes against human nature. When markets rise, impatience pushes investors to chase excitement. When markets fall, impatience pushes them to escape discomfort. The market tricks people into thinking that action equals progress. So they buy high when the story looks good and sell low when emotions turn dark. That is the exact opposite of how compounding works. Compounding rewards the investor who stays still while others are running in circles. This becomes especially challenging because the market bombards investors with noise. Headlines scream about the latest crash, the hottest stock, the billionaire investor who made a quick fortune trading tech shares. Financial media profits from urgency, not wisdom. They encourage constant movement because calm, patient investing doesn't make for dramatic news. Ask yourself, who gets more attention? The person who quietly invests for 40 years, slowly becoming a millionaire, or the trader who claims they doubled their money in a week? Excitement sells. Patience does not. Yet patience builds the wealth that excitement only dreams of. So how do great investors stay patient when everything around them is screaming act now? They view the market differently. Instead of seeing ups and downs as threats, they see them as normal behavior. They understand that volatility is the price you pay for long-term returns. They accept that there will be crashes, corrections, recessions, panics, and periods where their portfolio feels stuck. But they also know this: historically, every market decline has been followed by recovery. The market does not reward pessimists, gamblers, or geniuses. It rewards believers. There is a famous saying, time in the market beats timing the market. You could hold the most boring index fund and outperform the majority of traders who think they're smarter than the market. All because while they were making emotional decisions, you let compounding quietly do the heavy lifting. Patience is also about understanding that wealth creation progresses slowly until it doesn't. The average investor gives up at the exact moment compounding is about to get powerful. Imagine investing for 20 years, building decent returns, and then quitting right before the exponential growth phase. That is what many investors unknowingly do. They give up inches away from treasure because they think progress is too slow. The great wealth of Warren Buffett didn't come in his first 50 years. Almost all of it came after age 60. Why? Because compounding finally had enough time to show its full potential. So a critical question emerges: can you stay invested long enough to see the magic happen? Or will you let impatience rob you of your future? Patience is not the absence of fear or doubt. It is the decision to move forward despite them. When markets fall, patient investors ask, is my strategy still sound? Is the business still strong? Do I believe in the long-term story? If the answer is yes, then market volatility becomes an opportunity, not a threat. This mindset separates long-term investors from everyone else. The impatient investor sees a stock price drop and believes something is broken. The patient investor sees the same drop and believes value has improved. Investors like Charlie Munger say the big money is not in the buying or selling, but in the waiting. Peter Lynch reminds us that far more money has been lost preparing for corrections than in the corrections themselves. Howard Marks teaches that controlling emotions is the true path to profitability. They all point toward the same truth: patience is an investing superpower. But patience must be paired with conviction. It's not enough to simply hold investments, you must understand why you hold them. That is what protects you from fear. Knowledge becomes confidence. Confidence becomes discipline. Discipline becomes wealth. Here is the paradox of compounding: the less you do, the better your results. Fewer trades, fewer emotional reactions, fewer attempts to outsmart the market. Simplicity wins. Consistency wins. Long-term thinking wins. But will you? That is the question every investor must answer. Are you willing to embrace boredom for the sake of greatness? Are you willing to be patient, not just when things go well, but especially when things go wrong? Can you stay focused on the future others cannot yet see? Because wealth doesn't show up in daily fluctuations. It shows up in decades of discipline. The secret to financial independence is simple: give compounding uninterrupted time to work. Do that, and your future self will thank you in ways you can barely imagine today. The long-term mindset: transforming your financial future through consistency and discipline. Long-term thinking in investing is less about the market and more about the investor's mindset. It forces us to confront our deepest fears, our impulses, and our desire for control. We want certainty, we want results, and we want them fast. But wealth doesn't bend to impatience. The greatest financial outcomes are born from delayed gratification. The problem is that delayed gratification isn't natural. Humans evolved to focus on immediate survival, not future prosperity. When our ancestors saw food, they ate it immediately because they didn't know when the next opportunity would come. That instinct remains in modern investors. So when profits appear, even small ones, many rush to take them. Selling early feels safe and smart. Holding long-term feels risky and uncomfortable. Yet the irony is undeniable: the true risk is in selling too soon, not holding too long. When we look at history's most successful investors, Buffett, Munger, Bogle, Lynch, they all share the same trait. Not incredible intelligence. Not secret market knowledge. But relentless commitment to the long game. Buffett says the stock market is a device for transferring money from the impatient to the patient. This reveals a fundamental truth: the people who panic, who quit, who chase shortcuts, are the ones funding the wealth of those who stay the course. So how can we strengthen our long-term mindset? First, we must understand that markets move in cycles. There will be periods where everything rises and people feel wealthy. Then declines will come, and doubt will take over. Recessions, crashes, bear markets, they are not signs to run away, but required ingredients in building wealth. Without downturns, there would be no bargains. Without bargains, compounding wouldn't be able to accelerate returns. Risk is not a bug in the system, it is the price of admission. The investor who refuses to pay the price will never earn the reward. Another critical part of long-term thinking is accepting boredom. A portfolio that grows slowly might feel dull compared to fast-moving trades or speculative bets. But boredom means discipline. Boredom means you are resisting the temptation to overreact. Boredom means you have a plan and you are sticking with it. As Charlie Munger famously said, the big money is in the waiting. If investing feels thrilling, you might be doing it wrong. If it feels calm, steady, almost ordinary, you are likely on the right track. This leads us to one of the greatest challenges in long-term investing: comparison. When others seem to make money faster, doubt starts to grow. You begin to question your approach. You wonder if you are missing out. But comparing your financial journey to someone else's is a guaranteed path to poor decisions. They have different goals, different timelines, different risk tolerance. Your future does not depend on how fast someone else becomes rich. It depends on how disciplined you remain in your own strategy. Long-term wealth isn't built on speed, but direction. The investor moving slowly in the right direction will always outperform the one moving fast in the wrong one. Then there's fear of losing money, fear of making a mistake, fear of economic disasters. Fear is one of the most powerful forces in the market. But fear can only control those who allow themselves to be guided by emotion instead of strategy. The antidote to fear is knowledge. When you understand what you own, why you own it, and how its value grows over time, market fluctuations lose their power. Howard Marks reminds us that it is not enough to have an opinion, you must understand the probabilities behind it. Long-term investors study fundamentals, not rumors. They trust financial reality, not social media speculation. They seek truth, not excitement. Another essential pillar of the long-term mindset is automation. By investing on a consistent schedule, weekly, monthly, yearly, you remove emotion from the equation. You participate in the market no matter what the headlines say. Small contributions accumulate into meaningful wealth because consistency multiplies time. Time multiplies money. And the more time your money has to grow, the more exponential the results. Let's imagine two investors. One invests a large amount once and then stops. The other invests small amounts regularly for decades. Who becomes wealthier? Almost always the one who stayed consistent. Even modest investing habits can create extraordinary outcomes. A person investing slowly but steadily for 30 years will surpass the one who invests aggressively for only a short period. Because the ultimate power in finance is not how much you invest, but how long you leave it alone. This is why financial success is not only about intelligence. It is about behavior. Emotional intelligence is more important than analytical intelligence. Patience beats prediction. Discipline beats brilliance. The investor who can control themselves will always outperform the one who tries to control the market. So the final question becomes, can you build the mindset required to reach financial freedom? Will you resist the urge to chase trends? Will you stay calm when others panic? Will you allow time to do its job? Wealth created through compounding doesn't just change bank accounts. It changes lives. It provides security in uncertain times. It gives freedom to pursue passions. It creates legacy. But only for those who are willing to think beyond the now. The journey to financial freedom requires courage, patience, and unwavering belief in the future. You don't need to be the smartest person in the market. You only need to stay in the market. Your greatest financial asset is not your income. It is your ability to stick with a long-term plan even when emotions try to break it. If you choose to embrace long-term thinking today, your future self will thank you. Not tomorrow. Not next year. But decades from now, when compounding reveals the extraordinary hidden inside ordinary choices. The question is, will you commit to the long game? Will you choose growth over greed, discipline over distraction, patience over panic? Because in the end, financial freedom is not a matter of chance. It is a matter of time. And the sooner you start thinking long-term, the sooner the future starts working for you instead of against you. This is the true power of patience. Before we wrap up, let me ask you one final question. Are you ready to let time become your greatest investor? The power of compounding is real, but only for those who stay disciplined, patient, and committed to long-term thinking. What decision will you make today that your future self will thank you for? If you found value in today's video and you want to continue exploring the mindset that creates extraordinary results in the market, make sure to subscribe to the channel. Join us on this journey of becoming smarter, calmer, and more strategic investors. Share your thoughts in the comments. What is one investment decision you're now inspired to approach with more patience? I'd love to hear your perspective. Thank you for watching. See you in the next episode.